everybody to DeRosa Insiders Live. I am your temporary host for today. I am Jacob Sandoval, Head of Investor Relations here at the DeRosa Group, stepping in for Matt Faircloth, and I am joined by my friend, my partner in crime, the brains of the DeRosa Group. We have Hait Patel. The DeRosa Group is going to make this 15-minute underwriting tool. So what Hait is going to take us through today, it is going to be available for free download. We, as a DeRosa Group, we love to provide value to our investors, to our potential students, and we want to make sure that you have the tools necessary to exceed in the real estate investing space. So this 15-minute underwriting tool is going to help you screen quickly whether or not a multifamily deal is going to be worth pursuing or not, because Hait spends all his time here analyzing all these deals, but there are a lot of deals that are not worth Hait's time, and he needs a efficient and effective way to screen whether or not these deals are worth taking a closer look, worth doing a full underwriting, and this is the tool in which he does that. Hait, I will let you go ahead and take it away. Give us the background on the tool, how to use it, and walk through an example here for the listeners here.
So it's up and running. So this is our free tool we developed about almost a year ago. This was something that we were just using internally to, like Jacob pointed to, we get anywhere from 5 to 10 deals a week. Then it's just trying to stay on top and see which ones are worth pursuing at the end of the day. So this one's a very simple tool in that, what is your target IRR and cash on cash? This one is an example of, I believe, a 100-unit property or 92-unit property that we made recently. This was a particular deal in, I'll just say Carolinas. So this was a deal in Carolinas where the market rent was underappreciated, or we had a lot of room left for growth along with a pretty good CapEx budget. We threw it into the tool very quickly, along with what the exterior CapEx, the biggest CapEx spending was going to be the roofs on this building. The roofs were in pretty rough shape. 3 or 4 of them needed completely new roofs. Otherwise, 2 of the buildings need a little bit of patch-up work. So we had about a pretty good budget for exterior. And then landscaping being another big one, along with exterior siding, just a lot of wood and paint that just needed to be touched up and everything all around the buildings. This tool allows you to go ahead and put your unit sizes, and if you don't want to do it in a bulk, you can also just break it down into however many different unit types you have and go each by line. After you do that, you'll get your assumptions here for 10 years is what we have the tool based on. What you think the vacancy is going to be. This property is already stabilized. It was already doing 7% occupancy. So we just brought it down to a normalized 5% vacancy as we're going to be ramping up the revenue. Loss to lease was around 2% based on year one's rent. We had a lot of leases that were expiring. So the plan was to do quicker renovations at this property. Hence why the loss to lease is around 2%. You might have a property where you're taking on a heavier CapEx budget, or the property is very small, where it's going to affect your vacancy and loss to lease more. So just make those adjustments based on your particular property and the needs for that. But yeah, after everything is done, expenses and whatnot, we'll get our projections, just the NOIs and the growth on that, along with net income, and then we'll get a go or a no-go. Basically, this property hits a 13% IRR and a 7.35 cash on cash. So after this, we'll definitely take a look at it more in detail. The IRR and cash on cash number don't necessarily have to be 13 or 7. This was just a Class C property, hence why we started off at 13% IRR and 7% cash. Once we add a supplemental loan or refinance, those returns are going to look a lot better. This is just from an initial perspective. You're looking at a Class A property, Class B plus, the returns are going to be adjusted for those. So it just depends on how you're using this tool. You have the freedom to make those adjustments as you need as well. And when you input it, what your target is. But yeah, it's a very quick tool, and you can find more details when shared over here.
Yeah, absolutely. Hey, let's go a little bit deeper here on underwriting in general. I feel this is an area of investing where a lot of newer investors can feel intimidated by the process. Maybe they don't consider themselves to be particularly strong with analysis and spreadsheets and numbers. What are some of the areas where you feel you see the most mistakes in underwriting, and just some of the pitfalls for people to avoid in terms of starting on building that underwriting skill set?
Yeah, underwriting is one thing. It's also working with your current maybe management company or asset management team to see if you're talking about, let's say, for example, another 100 units multifamily project, and we as underwriting are predicting that we'll renovate 50 units year one. I just don't think it's realistic. You want to make sure that your management company or your asset management has the information needed to make sure how many units we are going to be renovating renovating in 1 year, and we can build out the impact of those renovations and the growth in the revenue. Because we at DeRosa, our projects have particularly been anywhere from 18 months to 36 months. 2 years to 3 years is what a bigger property has taken us to renovate it completely and stabilize the asset. So as far as having that conversation actively when you're pursuing an asset, because that's going to affect when you're going to get the most out of your refinance value. And if it's not a refinance, you're going to likely take on a Freddie or Fannie Mae supplemental loan. So that's going to have an impact on when you're predicting whether that's going to happen in year 3 or whether that's going to happen in the 4th year. So that's something that people don't spend a lot of time on, is to see how the renovation scope is and how long it's going to take and what the impact of that is going to be on the revenue as you increase revenue. So along with that, a lot of the properties are going to have additional fees that you might not, as an underwriter, you might not necessarily be aware of. The impact of adding a pet spa, what is the impact of that on getting more amenity fees, or what is the impact of that on overall rents? We know as underwriters, like the rough cost of adding a pet spa might be anywhere from 20 to 30,000 depending on location where it is. But what is the value that we'll be able to get out of that? That's going to be a conversation, along with other fees such as cable, Wi-Fi, trash, valet trash, if any of those came to the property. What is going to be the impact of that on the management team along with the payroll, and whether it's worth having those conversations. So that is something we definitely need to spend more time on, because when it comes to finances, we're always keeping up with checking treasury every day, basically at the open, at close, even midday. If there's a deal that we have on hand, we're probably checking it every 30 minutes. Checking treasuries, obviously, we are always talking with our loan brokers, or whether talking with the bank directly. We're having those conversations on a weekly basis. So we're always staying on top of those kind of things. Whether it's also talking to our real estate brokers in terms of what the cap rates have been, how those have adjusted. We're also tracking all that data internally, specifically in the markets that we are operating with, how the cap rate has traded from. It used to be around like 4.9, right now it's about 5.3%. So just trying to stay okay. Where can we find a value or a building that's basically unappreciated at the moment? So all those kind of things are very good when you're doing the analysis for underwriting, but also working actively with the asset management or property management team to see how the actual property is going to be able to maintain any of the other incomes or anything you're trying to create on the side.
Yeah, no, that's such an important point, and one that I love that you made, because at the end of the day, underwriting, deal analysis, whatever you want to call it, it's all well and good, right? But you can make the spreadsheet say whatever you want to say, right? I think the phrase in data analysis is just garbage in, garbage out. If you're putting garbage things into the spreadsheet, bad assumptions, bad timing of the business plan, incorrect rents, then that deal on paper can look a lot better than it actually is. But if you go to your asset management team and say, hey, how realistic are these rent bumps? How realistic is this renovation plan? Am I under or overestimating what our CapEx budget should be? And you have to ground those numbers in reality. You have to do exactly what Hait is saying. You have to marry what the spreadsheet is saying to what is actually possible to execute in the real world. And if you don't have that step, the connection point of the numbers to the asset management team, then you're really baking in way too much risk or way too much uncertainty into your plan. And we have many examples that happen like that at the DeRosa Group every day, right? Hait puts something in terms of underwriting a deal, goes to the asset management team. The asset management team says, hey, I don't think that, or they'll visit the property, right? More importantly, and they'll say, hey, I don't think that we actually can achieve those rent bumps. Or actually, I think you need to increase the CapEx budget, which takes a deal from what looked like a green light go to maybe a no-go, right? Because you take out those rent bumps, you increase the CapEx budget, we fall below the threshold of the IRR, right? So if you don't have that discipline as an operator, or if the operator doesn't have that discipline, then you're not baking in the reality of the deals. Hey, I love that you said that, because at the end of the day, that's what's actually the most important in underwriting. It's not how pretty the spreadsheet is. It's not how advanced the analysis is. It is how grounded in reality the numbers are to the actual details of the business. So that's, I think, if you take nothing else away from this particular episode today, it's how grounded are your numbers? How grounded is your analysis in the reality of the business? And are you potentially lying to yourself with some of these assumptions? Hey, it's right. I think that's where a lot of operators did get into trouble. We have a section here on the assumptions, and maybe you can speak on this, Hait, in terms of mistakes, but this is critical. This is critical. You can make, just by this box alone, maybe aggressive rent growth, maybe not being aggressive enough with expenses, this is where you can get into a lot of trouble. So, hey, maybe talk a little bit about the importance of making very realistic assumptions and how that has gotten operators into a little bit of trouble in the past when they just weren't realistic enough and maybe lying to themselves about these numbers.
Yeah, no, that's a really good point. And assumptions and expectations and execution. There's three different. I can have rent growth be 10% if I wanted to, but in reality, is that the execution plan? No. And to your point, what you mentioned, right? Once we do visit a property, let's say in the Sun Belt area where it's expecting like 5 to 10% or 5 to 7% rent growth over the next 4 or 5 years, but this property is just in a terrible area where we think the rent growth is not going to be anywhere near that. We need to have those conversations to make sure our assumptions are the most accurate. Like, to particularly in our NOI ratios are completely opposite, or not opposite, but our NOI ratios are very different in upper Midwest compared to in Carolinas. You have more additional cost up here. Labor is higher up here, along with you need to account for snow removals. You also need to account for landscaping for all 4 seasons. You're not necessarily paying those kind of fees down south. So NOIs are, people have general rule of thumbs like, hey, 40% of NOI are based on revenue or 35 in that. We take a very realistic approach to that. We don't make those assumptions. We will input every expense as it is and see what the property is performing. We still look at it from a percentage perspective where we are, but we're not just going to make an assumption that the property is going to perform at a 40% NOI. So assumptions will make or break the deal. They can make the spreadsheet a lot better if I just take 2 years of rent growth, like even year 1 to 5% and year 2 to 5%. It's going to have a very positive impact on overall property, because all of a sudden you go from 13%
13.5, yeah.
So it's very critical that your assumptions are accurate.
Yeah. And I think a lot of what, because we have the DeRosa Group for the past 2.5 years, we have almost been pencils down. The Red Wing deals have been the deals that we've brought in. Those were both development deals, so the unit economics of those deals are a little bit different. But for the most part, just traditional value add acquisition, we've been pencils down for almost 2.5 years, and that's just simply because when Hait and his team go through this process, we are just not seeing the risk adjusted returns that we want to see, and it doesn't pass our smell test in terms of when you put in realistic assumptions, right, with the rent growth and the expense growth, and when you build in, when our asset management team goes to visit these properties, when you go through all the checks that you should go through, the numbers at the end of the day, they don't pan out the way that we want to see them. And so we pass on those deals. And we've done that for a period of time, but you have to maintain your discipline as an operator, whether you're an LP or whether you're someone that's an active operator. This is a very critical point because, like Hait and I have said many times, you can make the numbers say whatever you want. We can take this exact deal to our investors and say, hey, this is going to be a 16.4% IRR, but we know that those rent growth numbers aren't realistic. And that is important. And again, if you take nothing else away from this, it's make sure that what you're putting into the spreadsheet is in some way, shape, or form grounded in reality. And look, a lot of what underwriting is a forecast. It is a best guess, but it's up to you as the operator to make sure that you are getting as accurate as possible with this forecast, so that at the end of the day, we can sleep at night knowing that we passed on a deal that could have been a good deal, but it just didn't pass our standards as a DeRosa Group. And that's how we operate, and we have to operate with integrity. And so that is, I think, where we'll round out the episode today. We're getting close to time here. Hey, any kind of closing thoughts before we wrap up the episode on hotels, underwriting, anything we talked about today?
No, for both the assets. For us, DeRosa particularly, we've been looking actively since I've joined. It's just been, the interest rate have not been favorable. We've seen expenses grow, which has been true to any region in America. An appliance set that used to cost like maybe $1,500, now it's upwards of $2,800 for stainless steel black appliances. Our CapEx budgets have increased. So value add, particularly the ones we were looking at value adding B- or C+ assets, those are just not been penciling out because the reward or the risk adjusted reward is just not there. We are not going to do a C- asset for a 12% IRR based on our assumptions, right? And our assumptions are, I want to say, conservative, and that is because we want to deliver beyond expectations. So have a very realistic approach to these assets.
Absolutely. Hey, I want to thank you for obviously sharing your knowledge today. For the listeners, I hope you found this video helpful, if nothing to help you with your own underwriting, or if you're an investor with the DeRosa Group, to show you the rigorous standards that we as DeRosa put every single deal through. We scrutinize every single deal, Hait and team, so that by the time it makes it to our investors, that we have gone through all the checks. We have underwrote the deal several times, way more in depth. We've not just screened it with 15-minute underwriting tool. We have fully underwritten it multiple times, have the asset management team visit the property, make sure that our assumptions are grounded in reality before we take it to the investor base. So that is what you can have confidence in as an investor or potential investor with the DeRosa Group, that we are putting every single deal under a microscope to make sure that we are getting as accurate as possible with the underwriting and with the forecasting. If you want the 15-minute underwriting tool, you can go to derosagroup.com/underwriting tool. You'll just put in some information there and you'll get immediate access to the tool. We highly encourage you use this deal as a first step in your underwriting of your multifamily properties. There's obviously a much more in-depth tool that we provide to all of our Accelerator and Accelerator Plus students, but download the free underwriting tool at derosagroup.com/underwriting tool. Get started with that, play around with it. If you have any questions, you can reach out to me, whether you are an investor or you're looking for a mentor to jumpstart your multifamily investing journey. You can make sure to book a call with me. We're happy to meet anybody in the space and help out in any way that we can. I'm Jacob Sandoval, your temporary host for DeRosa Insiders Live. He is Hait Patel, our brains of our operation. We hope you enjoyed the episode today. We will see you guys in the next one. Signing off now. Goodbye.
Yeah.